Hello, Accounting 202 students. Today we're going to be talking about Chapter 24, Decentralized Operations. So let me share my screen with you and then also take my video down. So Chapter 24, I want you to know that we are not covering the whole chapter. We're only covering the chapter through, or I should say up to the part where we talk about the balance scorecard. So we want to focus in on what are decentralized organizations. And so the best example that I can give you, all right, it really comes in a picture. And I'm not sure if the picture is actually in the textbook, all right, but when we're talking about the difference between a centralized organization and a decentralized, here, let me make this a little bit smaller, all right, so that you can see the whole slide. All right, when we're talking about centralized organizations, really what we're talking about is we're saying, hey, we have our CEO, okay, and he's surrounded, okay, by a bunch of different, divisions or products or stuff like that, where it's the CEO that is making all the decisions, right? Sometimes this is referred to as micromanaging, right? Whereas decentralized organization, yes, you have your CEO at the top, okay, then under him, okay, he has some various different VPs, and then the chief financial officer. Okay. Under your chief financial officer, basically is divided into two things. You have your controller, and you have your treasurer. And under your controller, you have various different employees, and this is the typical what's referred to as the corporate ladder. All right. So these guys down here, okay, they have the ability to make some decisions. They're not going to make overall decisions that can compromise the organization, all right, but they can make decisions related to their area of responsibility. Now, just a little FYI, if your desire is to be the top dog or the CEO of an organization, okay, know that 80% of these guys come from an accounting background. Okay. Yeah, again, I'm just trying to fish, all right, because accounting is a great major. All right, so if you want to be the top manager, top person in an organization, the accounting pathway is a very good pathway. And so when we look at the advantages and disadvantages of a decentralized organization, because that's really where we're going to spend our time. With decentralized organization allows managers closest to the operation to make the decisions, right? Because they are given some power, all right, to make decisions. We don't have to run all the way up to the top CEO position to get permission. It provides excellent training for managers, right? So they can become expertises in their area. It allows the managers to become experts in the area of operation. It also helps retain managers because if they see that they have upward mobility, all right, they're more likely to stay with the organization. And it improves creativity and customer relations. Because the people that are on the ground dealing with our customers, you do have limited, but they do have authority to meet the needs of our customers. However, there are some downsides to decentralized organization. All right, first of all, decisions made by the manager can negatively affect the total profits of the organization. So we kind of talked about this way back when we talked about budgets, and there's goal conflict. All right, one manager may have a specific goal that benefits him and his organization, but actually hurts the organization as a whole. And then there's the other area of having duplicate assets. So if we have a really large organization, it's possible that we may have two different accounting departments. So kind of a little personal story. I had a colleague who was on my advisory board that was the head accountant for Lee Memorial here in Dowagiac at the hospital. She was the top accounting manager at the hospital. Well, they had an accounting office in Dowagiac, they had an accounting office in South Bend, they had an accounting office up in Kalamazoo. All right, so at all their locations, they had all these accounting offices. Well, at one point, they actually came and decided that they were going to consolidate the accounting department, and I think it was down in Indianapolis somewhere. And so basically, they were doing away with my colleague's job. They did offer her a job down in Indianapolis, but because she was already close to retirement and she was a grandmother, she didn't want to leave the Wajak. She just chose to take the early retirement. But what they were trying to do is they were trying to eliminate all the different accounting positions and consolidate them in one department down in Indianapolis. And so when we're talking about a decentralized organization, all right, we're going to be looking at managers and evaluating and controlling their areas of responsibility. Okay, these are referred to as responsibility centers. And so there's basically three responsibility centers that we're going to discuss. We're going to talk about cost centers, profit centers, and investment centers. Okay. So obviously, responsibility accounting is that you're only responsible for what you're responsible for. All right. So a cost center, okay, they're only responsible for costs. Okay, for the spending of money and use of assets. Whereas a profit center, right, looks at both the revenues and the costs. So this is just costs. And where the investment center is kind of big picture. All right, this is the top management where they have responsibilities over revenues, costs, and investments. And so we're going to spend the rest of this time together basically looking at how to account for those different areas. So responsibility for a cost center, all right, they only have control, as I said earlier, over their costs. However, a cost center manager does not make decisions concerning sales or the amount of fixed assets invested in the center. A cost center may vary in size from a small department to an entire manufacturing plant. And cost centers may exist within other cost centers. And so they give the example of a university where the overall university is broken into the College of Business, right? And part of the College of Business is the Department of Accounting. And so this is really my area. I'm theoretically or technically called the lead accounting instructor. All that means is I choose the textbooks and generally make all the Moodle pages and exams and quizzes and all that sort of stuff. All right. So I'm not actually responsible for going out there and recruiting students. All right. That's held maybe at a higher level at the university level, with our recruiters and whatnot. But I'm just responsible for the costs that my department incurs. Whereas the College of Business, they're also not responsible for going out and generating revenues. They're just responsible for the cost of the College of Business, and so on and so on. And so responsibility accounting for a cost center focuses on the controlling and reporting of costs. And so last couple chapters, we've been preparing a budget. In the last chapter, we looked at variances, or how did we do when we compared what actually happened to our budgets. Right? And so budget performance reports are just that. Right? They're really looking at the difference between what was budgeted and what actually happened. Right? And so we're going to have different variances to identify those. And so here's an example, right, of a cost center, okay, for the production department. All right, and so this is for production. And so the vice president of production has multiple plants, okay, plant A, plant B, and so he has a manager that's responsible for his plant, okay, and then underneath there they have the different departments, and then you have the various different supervisors. And so if you know anything, all right, you know that top management, they really don't want to get stuck in the details, all right? They kind of want to have big picture ideas. And so they're provided this vice president's report or budget performance report. And really what it does is it identifies, hey, you know what? this vice president, he's in charge of administration, plant A and plant B. And so we can see that, hey, plant A was over budget. Okay, that's an unfavorable variance. Okay, and so he kind of says, hey, all right, get me Steve, all right, the plant manager for plant A, on the phone. He needs to explain why we're, let's just add some zeros to that, $2.8 million over budget. And so, of course, he sweats a little bit. Steve does, right? And so what he does is he says, hey, give me the budget performance report, all right, for my plant. Okay. Now, I want to point out something, all right, that, if these two plants are producing the same thing, right, the manager from plant A, he better not just say, oh, hey, that's inflation. Okay. It's inflation that we're over budget by this 2,850 million dollars. Okay. The reason being, all right, is if plant A and plant B are producing the same thing, and plant A is saying, oh, it's because of inflation, then what is plant B doing, okay, where they're under budget? All right. So you want to know and understand really what's going on. And what we're just showing is, if you've ever heard the term, all right, human waste rolls downhill, all right, to try to keep it somewhat clean. All right, that's what's happening here. All right, plant A manager, he's over budget, and so the VP is getting him on the phone to find out why. Okay, and so the manager in plant A says, okay, hey, it looks as if Department 1 and Department 2 are causing us to go over balance. All right, and so he calls up the supervisors for plant 1 and or I should say Department 1 and Department 2. Okay? And we can then identify what really happened. And so the biggest issue right here is materials. So the VP up here, he just wants to find out why they're over and if there was anything that we could do, all right, in order to decrease that unfavorable variance. And so a profit center, okay, moving to the next responsibility center, as we said earlier, is really responsible for those costs, the costs that we just talked about, but also for profits. Okay? And so a profit center may be a division, a department, or product. Okay? The manager does not make decisions concerning the fixed assets invested in those areas. Okay, and so we're going to use the example of really it's Disney, okay, and where they have both an amusement park and a movie production, right? And really see the differences. However, responsible accounting for a profit center focuses on reporting revenues, expenditures, and income from operations, right? Which means responsibility accounting reports the profit centers, right? They start to look like the income statement. Now, I do want you to know, okay, that when we're looking at these divisions or these profit centers, right, there are some things that are controllable and some things that are not controllable, right? And so controllable revenues are revenues earned by that profit center, right? So, they're not responsible for the profits of other centers or revenues from other centers. You're just responsible for what they are responsible. And that's the same thing with controllable expenses. Because really what we're going to do is we're going to look at that scenario that I mentioned with my colleague and her accounting position at the hospital, right? Because if we have departmental services, okay, because each hospital gave up their accounting department and they centralized them, right, into the accounting service department. Okay? They really don't have control over the salaries of those accountants or the costs that they incur, right? They are just going to be charged back, right? So this term charging back refers to departmental service charges. And so controllable expenses of a profit center include direct operating expenses such as sales salaries and utility expense. Addition, a profit center may incur expenses provided by an internal centralized service department. And, these are possible, departmental services, okay? research and development, legal, all right, accounting, all right, transportation, human resources, okay. And so in a profit center, a manager of a division might not be responsible for some of those. And so service department charges are indirect expenses to a profit center. They are similar to expenses that would have been incurred if a profit center purchased the service from an outside company. A profit center manager has control over service department expenses if the manager is free to choose how much the service is used. But that is usually not the case. Okay, well, I guess in such cases, service department charges are allocated to profit centers based on the usage of the service by each profit center. Right? So I guess we are going to look at that. But really what I was thinking that was saying, all right, was that, these managers, they don't dictate the salaries, right, of the purchasing department or of the accounting department, right? That is taken at corporate level. Right? So the NOVA Experiment Group, or NEG, right, is a diversified entertainment company, all right, and it has our theme park and our movie production, right. And so, like I said, would be an example of Disney, even though Disney actually has more, um, divisions, okay, than just these two. And so we have the revenues and direct operating expenses for the two different divisions, all right? So we have revenues for the theme park of 6 million, operating expenses of 2.4, and then the movie production, 2.5 million in revenues and 405,000 in operating expenses. So the operating expenses consist of direct expenses, such as wages, salaries, and division of employees. However, all right, they utilize three different service departments. Okay? We have purchasing, we have payroll, and we have legal. And so if you remember back when we talked about factory overhead and the allocation of factory overhead, if you remember, one of the things that we did is we looked for cost drivers, right? Things, all right, that made our factory overhead go up, all right, or things that drove. And in our case, we actually use direct labor hours. So if you look at these areas, all right, we have a purchasing department, let's just say it's down in Indianapolis, okay, that incurs the total organization, in this case, NEG's total organization, both departments. Okay? And that came up with a cost of 400,000. Payroll, 255, and legal. What we want to do is we want to find a good cost driver. So if you think about it, all right, a good cost driver, all right, for a purchasing department would maybe be the number of POs, right, or purchase orders. The payroll accounting, all right, is probably going to be the number of employees. Okay. And legal is probably the number, okay, of hours, all right, that each of these two different divisions use. Right? And so if you think about this, there's this actually technical term, all right? Remember, we have two different departments. We need to allocate this full amount, all right, to our two different departments. Now, there is a method, and the correct legal term or official term is called peanut butter costing. All right, and peanut butter costing just says, hey, if we took this $905,000 and spread it evenly over our two different divisions, we would have had 452,500. Okay, that would go to the entertainment parks. Okay, and the same 452,500. Okay, that would have gone to our movie production. Okay. This is spread evenly, and that's where that whole idea of peanut butter costing comes from. All right, but it's not a good allocation of cost, right? Because in some cases we're going to overcost one division and undercost an additional division. We get into this a lot more in Accounting 214, right? And so we'll just hang on to that until then. And so, as I said, we're looking for cost drivers, number of purchase requisitions or purchase orders, number of payroll checks, which would represent the number of employees, and the number of billable hours. And so what we do is we find out that, hey, we have 40,000 purchase requisitions from the two different divisions. We have 15,000 employees. We have 1,000 billable hours, right? And they're broken into their weighted averages, right? Or their actual. And so what we're going to do is we're going to calculate, all right, a service department charge rate. Right? And so we took that 400,000 total cost, all right, of the purchasing department. We divide it by the total number, all right, so the total number of purchases, okay, and we come up with $10 per requisition, all right. We do the same thing for payroll and the legal, and we find out the billable, or the chargeback rates. So once we do that, all we do then is we multiply, all right, those service department charges against the actual services. And so that's what we did here, right? So if you remember this, totaled the 40,000, okay, purchase requisitions, this was the 15,000 employees and so forth. And so we just took that rate, okay, multiplied it times the purchase requisitions for the theme park, and we came up with the 250. And so, if you look, and we did we now are allocating, all right, 479 to the theme park and 426, all right, to the movie production. If you remember, okay, if we did the peanut butter costing, that was 452, 500, right? If we would have allocated that to the movie production, we would have over costed, the movie production division, and we would have under costed the theme park. The way that we did it here, okay, using the service department charges, okay, is a better, more accurate allocation of costs. And so we plug that into our divisional income statement, all right? So we had our controllable revenues, our controllable expenses, all right? Gave us income from operations before departmental service charges. Okay. We added all the departmental service charges from the previous screen, okay, from up here. Okay. All right. And we come up with income from operations and, for both divisions. A much better allocation of costs. So in evaluating the profit center manager, the income from operations should be compared over time, okay, not, all right, against other divisions, all right, because, the movie department has nothing to do, right, with the entertainment parks, right? And so you don't want to compare apples and oranges. You want to compare apples with apples, right? So it should not be compared, right? Should not be compared across profit centers, all right? Because the profit centers are usually different in terms of size, products, and customers. The next area, all right, is an investment center, all right? And so this is top management, okay? They're responsible for not only the costs and revenues, but also for invested assets. Investment centers are often used in diversified companies, right, by divisions. In such cases, divisional managers has the authority similar to that of a chief operating officer or a president. Right? Because investment center managers have responsibility for revenues, expenses, and income from operations as part of an investment center reporting, okay, and in addition, because the manager has responsibility for assets invested, the following two additional measures of performance are used. All right, so we're not ignoring the stuff that we covered from the profit center, but really what we're going to add is another way to look at things. We're going to look at things based on the rate of return of the investment, and another method, the residual income. And so here we have two different divisions. We have our northern division and our central, actually there are three different divisions, northern, central, and southern. Okay. And you can see that in northern divisions, they have income from operations of 70, right, 84, and 75. So which one of these would you want to be responsible for? Right? just looking at those numbers, I would say the central division. Okay? However, okay, if you look a little bit deeper, see, this is only an income statement thing. Right? We didn't take into account the balance sheet at all. Okay? See, because on the balance sheet, it's going to show us the assets that each one of these divisions had. All right. And so if you've ever heard the term too much is given, much is required, that's kind of what we're going to be looking at here, right? See, when we look at a return of investment, the investment is what we put into that different division. Because investment center managers control the amount of assets invested in their centers, they should be evaluated on the use of these assets. One measure that considers this amount is called the return on investment. The calculation or the equation for that is such: income from operations, okay, divided by the invested assets. And so in our previous examples, this was the income from operations. And all we're going to do is divide it by the invested assets. So the return on investment is useful because three factors subject to control by divisional managers: revenues and expenses, or the profit center, and the investments are considered. The higher the return on investment, the better the division is at using its assets to generate net income. In effect, the return on investment measures the income or return on each dollar invested. As a result, the return on investment can be used as a common basis for comparing divisions against each other. And so here are the assets. If you remember, it was the central division that looked really good. The problem is they have double the assets in that division than they did in the northern division. Okay. And so if we looked at the return on an investment, you can see that a 20% return is way better, okay, than a 12% return. So taking that return on investment, right, there's a company called DuPont, right? And DuPont is a conglomerate, which just means that they invest in all different types of things, all right? They actually started, I think, in Michigan, and they were a chemical company. But then they diversified into other areas. And they're the ones that came up with this thing called the DuPont formula, okay? The DuPont formula basically takes that return on investment and breaks it into two parts: the profit margin and the investment turnover. The profit margin shows your profitability, right? Where investment turnover, okay, really shows how efficient you are in using your assets. So in order to do this, what they do is they take the initial equation, return on investments. If you remember, we had income from operations divided by invested assets. And they break it into the two parts, okay? They add, all right, this sales. So if you know anything about fractions, I know very little, all right, but if you're multiplying two fractions and one denominator is the same thing as a numerator, you can eliminate those, and then you go back to our initial equation, right, the return on investments. But what they're doing is they're allowing, all right, let me erase that. Okay. They're allowing us, okay, to look at this as a profit measurement, okay, and this as an efficiency measurement. Okay. And so we go ahead and we're going to apply that to our three different divisions. I only think about two because I'm looking at the best and the worst, right? But the DuPont formula is useful in evaluating divisions because the profit margin and the investment turnover reflect the following underlying operating relationships. Profit margin indicates operating profitability by computing the rate of profit earned on each sales dollar. So if a division's profit margin increases and all other factors remain the same, the division's rate of return is going to increase. Whereas the investment turnover indicates the operating efficiency, right, by computing, right, the number of sales dollars generated by each dollar of invested assets. And so in looking at these, we look at the different areas, all right, and we can see that, you know, for the northern division, okay, their profitability, right here, basically what this says, it says for every dollar in sales we have, we're able to generate, right, 12.5 cents, 12.5 cents in profit. Whereas the investment turnover here, sales divided by invested assets, shows how efficiently we are at using those assets. For every dollar in assets we have, we're able to generate $1.60, right, in sales. And so really once we have those sales, okay, we use that to calculate our profitability. And so you can see, right, these are the same percentages, okay, that we calculated when we looked at just the return on investment. But what this has done is it allows us to compare, right, in different areas, because we can compare here. And again, I'm just looking at the northern and the central. Okay, you know, when you look at the profitability here, it's the same. Okay, you know, once the central division gets that sales dollar, okay, they're still generating that 12.5 cents. Where they're really suffering, okay, is in the efficiencies, okay, of their assets. And so hopefully what we can do is we can take things that we learned from the northern division and apply them to the central division to make the overall corporation more profitable. Okay. To increase the return on investment, the profit margin and investment turnover for a division may be analyzed. Okay. And so that's what they're basically doing here. All right. However, in this case, they're still using the northern division. They say, hey, assume that revenues in the northern division could be increased by $56,000 through increased operating expenses, such as advertising. Because if you remember, advertising is a fixed cost. Right? And so the northern division's income from operations will increase. All right. And we just crunched the numbers. We added the revenues. All right. You know, again, excuse me. The benefit of that, all right, we've also increased, all right, our operating expenses here, right? We've now created income from operations, all right, of 77,000 instead of the old 70,000. You plug that into our DuPont formula, okay, we go from that 20% now up to 22%. And so this just allows us another tool, okay, on decision making. So the return on investment is also useful in deciding where to invest additional assets or expand operations. Right? For example, DataLink should give priority to expanding operations in the northern division because they earn the highest return on their investment. Disadvantages, right, of the return on investment as a performance measure is that it may lead to divisional managers to reject new investments that could be profitable for the company as a whole, because they don't want to bring on the additional investment, all right, bringing down their DuPont formula. And so they run that same scenario here, all right. Assume that the following returns, all right. If the manager of the northern division invests in a new project, the northern division's overall return will decrease from 20%, right, due to the averaging out, right. Thus, the divisional manager might decide to reject it, even though it's profitable for the organization as a whole. Okay. Something closely tied, all right, to the DuPont formula is this thing called residual income. Residual income is useful in overcoming some of the disadvantages of the return on investment, okay, where residual income kind of looks at it like it's a hurdle. Okay, residual income is the excess of income from operations over a minimum acceptable income from operations. Right? Minimum acceptable income from operations is computed by multiplying the company's minimum return, okay, by the invested assets. Okay. So a minimum return, right? If you decide to do the Ferris program and take Finance 322, okay, I'll actually teach you, if I'm your teacher, how to calculate, right, what's referred to as a required rate of return or your weighted average cost of capital. Right? That's what's referred to as the hurdle rate. Okay? And so residual income looks like this. Income from operations, subtract a minimum acceptable income from operations as a percentage of the invested assets. gives you what you have left over to do with whatever you want, or what's left over or residual. And so if you remember, we took these straight off that first, where I asked you, hey, which one of these would you want to be manager of? And I said, hey, yeah, you want to do the central because they're making the most. Okay. But really what we're doing is we're saying, hey, we have a 10%, or we require 10% return, all right, on all of our divisions, okay, or all our invested assets. And so we took the $350,000, okay, and multiplied it by the 10%, okay, giving us the 35, right? And so we took the 70, subtract the 35, and we have residual income of 35 for the Northern Division. This also allows you to rank them, all right, just like the return on investment. This ranks as number 1, 2, and 3. Major advantage of residual as a performance measure is that it considers both the minimum acceptable return, invested assets, and income from operations. So in doing so, residual income encourages divisional managers to maximize income from operations in excess of the minimum, or in this case, the 10%. And so assuming that the return, all right, were these, okay, if the manager of the Northern Division is evaluated on new projects using the return on investment, the divisional manager might decide to reject the new project. This is because investing in the new project will decrease the Northern's current return of 20%. While it does help, that was one of the problems before. Okay? In contrast, if the manager of the Northern Division is evaluated on the residual income instead of the return on investment, okay, the new project would probably be accepted. This is because investing in the new project will increase the Northern Division's residual income. In this way, the residual income supports both divisional and overall the company as a whole. So that takes us to the end of chapter 24. I hope that makes sense. If not, I'll be open to any questions in our next class meeting.